Moving on to Seugnet de Villiers. She is a multi-manager fund manager here at Netgroup Investments, and her topic is on building wealth for the long haul, looking at equities in your retirement portfolio. Seugnet, take it away.
Good morning, everyone, and thank you so much for joining our final Multi-Manager Insights for 2025. Today, I'm going to unpack why we think that proper long-term focus is so important in retirement planning, even though we've seen a major shift away from growth assets into income assets over the last decade. If you look at the 10 years ending June 2015, the ASISA multi-asset high equity category received 4 times the amount of net inflows compared to the ASISA multi-asset income category. Fast forward to 2025, and now that number is at the multi-asset income category growing at twice the pace of multi-asset high equity. So for every 100 million rand that people allocate to high equity, we're seeing South African investors allocate 200 million into the income space. A very clear shift away from growth and into the comfort of income assets. Now, it's completely understandable why South African investors have made the shift. If we look at the performance of equity markets over the last 10 years, investors weren't rewarded or compensated for that additional volatility of equity exposure relative to the previous decade, or even relative to what you'd expect from a fundamental perspective. What I show you on this chart is just what the respective ASISA categories have given you over the 10 years ending June 2023, 24, 25, so the last decade on the right-hand side of the chart, and then on the left-hand side of the chart, what it did the previous decade, so up to 2013, 2014, and 2015. And you can very clearly see that in the last decade, whether you were in income, which is basically no equity, or whether you were in high equity, which has much more volatility, you receive the same absolute performance. Where in the first decade, investors were rewarded for that bumpy ride that equity exposure brings in the short to medium term. But the problem is the inflation risk is real when you're saving for retirement. We're quite fortunate here at the clock tower at our offices. The vagabond downstairs sells a good flat white for 29 Rand. But the other day when I bought a coffee at Kauai at the gym, or even at Mug and Bean at the airport, I couldn't believe when they charged me 40 Rand for a flat white. Because I can honestly remember when I was still paying 15 Rand for a coffee at Bootlegger. And this just shows you how extreme inflation can be. And it's not just over the long term. In a short space of time, prices can go up quite a bit. So what we're concerned about is that investors who are preferring or choosing the comfort of income is sacrificing their purchasing power in the future. And I want to look at this dilemma in 3 ways today. Firstly, I want to show you some real-life examples in rands and cents of what people saving for retirement and people who have retired in the last 10 years have achieved. Then I want to look at some market trends. Is it changing from an asset class perspective? And then I'll end off looking at where to from here. What do we tell investors today who are either saving for retirement or already in retirement? Okay, so let's meet Thandi. 10 years ago, she was 30 years old. She's earning 950,000 Rand. She's allocating 25% of her salary into a pension fund, and she's just changed jobs. So she has to make 2 investment decisions. Firstly, the R1 million that she saved up in a pension fund needs to go into preservation fund. She needs to choose a fund for that. And then secondly, she needs to choose into which type of fund she wants to invest her pension fund contribution at a new employer. So a monthly debit order going forward. Now, let's first look at what her lump sum did. I'm going to focus on the 10-year period first. So if she invested her R1 million preservation fund into a multi-asset income solution 10 years ago, she would have been in the exact same position today than if she chose a multi-asset high equity solution for that same R1 million. And that's displayed on the 10-year number towards the right-hand side of your chart. Now, this is actually quite a good outcome. As we saw earlier, the recent 10 years has been a terrible period for multi-asset high equity and an exception rather than a norm. Remember, in this 10-year period, we've had, if you think all the way back, we've had things like Brexit, Trump's first election, there was quite a shock. You've had COVID, we've had Russia invading Ukraine, pushing up interest rates and inflation. It's been an exceptional 10-year period. And even in this exceptional, often labeled unprecedented period, you are still in the same position financially today if you chose the multi-asset high equity versus income. But of course, the benefit of the high equity solution is you're now in the right asset class looking forward, given that you still have 20 years, 30 years, etc. to save. Just for interest sake, I also looked at where she would have been relative to each other if she chose income over equity over a 1-year, 3-year, all the way up to 25-year period. And over all of these periods, it's shown as an underperformance on the chart, she would have been between 1.5% and 3.5% per year worse off had she de-risked her preservation fund compared to just sticking to her high equity plan. Now, this might not sound like a lot of underperformance, 1.5% per year, but remember this compounded over the entire time frame that you're saving for retirement will either one day mean you can draw a much smaller salary or income in retirement if you don't have enough growth exposure, or your chance of a successful retirement will be materially lower. Then we also looked at what her monthly contribution decision would have looked like. So 10 years ago, she joined a new employer. If she chose or elected an income solution for her monthly contribution, how much does she have today? She has just over or just shy of 4.5 million rand. Compared to if she chose a multi-asset high equity solution for the monthly contribution, she's sitting at 4.8 million rand. So again, it's quite a close race. High equity has not shot the lights out, but she is still better off, and again, in the right asset class going forward. And the reason that the monthly contribution looks a little bit better than the lump sum investment is because the weaker period was in the first 5 years and then initially COVID. And the entire contributions, the entire sum of contributions that she made in that first period was fully exposed to the recovery we saw subsequently, and then she kept on contributing into that recovery. Hence the slightly better performance in the monthly decision compared to the lump sum decision. Now let's move on to someone that retired. And for this scenario, for this case study, I used John. Assume at any point in time of the analysis, he is 60 years old. He has 3 million rand to retire. We're giving him a starting drawdown rate of 6.5%, and we increase that income by 6% every year. So quite a nice inflation, especially given where inflation is at the moment. Now, his decision between am I retiring in income or am I retiring in an overall portfolio that is closer to a high equity solution will drive whether or not he can sustain his lifestyle or run out of money before, while he's still alive. So basically outlive his money. And we followed a similar approach to the lump sum scenario that we did for Thandi. I looked at today's value if he had retired 1 year, 2 year, 3 years, again, all the way up to 25 years ago, and he'd drawn income from the average multi-asset income fund or the average multi-asset high equity solution. And again, the current 10-year number is the exception rather than a new trend or a new normal that we're seeing. It is the only period over which he would have been slightly worse off in the high equity solution over the income solution. Then over a 20-year period, his worst nightmare came true a few months ago. If he was in income, he would have run out of money if he retired in 2005 into an income solution. And then on the far end of the spectrum is a 25-year period where you again saw this major success retiring from high equity over income. So I thought let's take a closer look to the 25-year period. Now what I show you on this chart is effectively his month-end market value of his living annuity every month. So this includes the growth of his capital that's lying there, but it also includes him or takes account of him drawing an income out of it. And again, I'm just showing you since he retired, the green line or the dark line being the income, the purple line being his high equity living annuity. And if John paid attention to short-term movements and underperformance or weakness in the first 10 years of his retirement, he would have thought he made the biggest mistake of his life sitting in high equity and not in income, because those first 7-9 years were quite weak. If he then switched and he said, oh, this was a mistake, let me get into the income category instead, high equity wasn't the right choice, he would only have around 2 million rand today, compared to sticking to the plan, staying the course in high equity, more than 4 times that amount. And in retirement, that's massive. Either he can draw a bigger income, or he can leave a larger inheritance for his loved ones, or a charity, or whatever it is that he desires. And I think this is quite a powerful lesson, because it just shows you the power of compounding and the power of growth assets, and the importance of keeping your capital at work even when you're already retired. Okay, now let's switch to the second part of the presentation, which is just quite a simple look at the asset classes driving what sits in the income solutions versus what sits in a high equity solution. Now, I've kept it really simple. I'm just using the SA Equity Index and an SA Cash benchmark just to understand what is the journey like in each of these asset classes, and is something changing that we need to be aware of when we make our investment decisions. What I show you here is the rolling 1-year period. Very clear to see that in any 1 year of performance, your cash benchmark, or your pure cash, is going to feel nice and steady and slow, almost like a kiddie's carousel, compared to the a pure equity index that's going to feel like a roller coaster if you're looking at your 1-year performance every month end. But if we stretch our focus to the 5-year period, 2 very interesting things happen. Firstly, the speed of the equity roller coaster slows down quite a bit. And secondly, the consistency of extra return that the equity market gives you over and above inflation increases and becomes quite steady. Compared to cash, it stays exactly where it was over the 1-year period. So even though you've now invested longer in the cash market, there's no benefit for you for staying invested for that longer period. If we switch to the 10-year period, that roller coaster of equity is even slower. Cash still exactly where it was over a 1-year period. And over a 20-year period, equity seems like a no-brainer if you're trying to outpace inflation over the long term. So my challenge to investors and to clients is to really stretch their time frame and what they're focusing on. If I just take myself for an example, at 39, I've got 24 more years until I have to retire at Nedbank. And then at age 63, I've got another 25, 30 years that I need to plan for. So my retirement savings time horizon is literally 50 years. And if you realize that and you really internalize that, then does one 10-year period that's a little bit weaker matter, or is it more about what the asset class can do for me over a 20, 30, 40-year period? So I really want to challenge clients to stretch what period they focus on in their retirement planning. Now, to end off, let's try and answer the question, where to from here? Well, firstly, from a fundamental perspective, interest rates and inflation will continue to drive global markets. So the income funds, what they can deliver is very tightly linked to the interest rate. Those instruments all give you the interest rate plus a little bit extra, very little growth potential. And then the equity market's also sensitive to what the interest rate is. So a lower interest rate is generally good for equities from multiple angles. So firstly, lower interest rate means companies are paying less for their debt. Lower interest rates generally means consumers have more money to spend, boosting their earnings. Or from a more technical perspective, if you're discounting your future cash flows at a lower interest rate, your net present value increases. So what I've done on this chart for you here is I've just showed you over the last 10 years where some of the major developed market interest rates have been compared to South Africa, and we're definitely at a lower starting interest rate today than what we were 5 years ago. And it's important to keep this in mind. And then looking forward, using our Big Picture app, which is built on more than 100 years of retirement scenarios, I again looked at someone saving for retirement and someone in retirement. So in this chart, or in this slide, I'm showing you what the likelihood of success is for someone saving for retirement across the different risk buckets That's what I show you on the left-hand side, and the right-hand side flipped the other way. How much of your salary do you need to save to achieve the same likelihood of success across the different risk buckets? In this scenario, this investor has 20 years before he needs to retire. He has 7 million rand. He's targeting 21 million rand in today's terms. We've assumed a replacement ratio of 70%. So if his final salary is 20,000 rand a month, the replacement ratio of 70% means we want him to be able to draw 14,000 rand in his first year of retirement. On the left-hand side, you can see a massive, massive impact on choosing income to save for retirement, 20% chance of success, compared to increasing the risk exposure to high equity, takes them up all the way to 76% chance of success. Flipped differently, to maintain a likelihood of success of 70%, how much must I contribute? If he wants to sit in the comfort of income, he literally has to give or invest 70% of his monthly salary into his retirement annuity or his pension fund. Not sustainable. Compared to choosing high equity, that drops all the way down to a 20% contribution, which is certainly more normal, realistic, and importantly, sustainable. Then if we look at someone who's already retired, in this scenario, we've got Bongani. He's planning a 30-year life expectancy. He's got 10 million rand saved. And what I've done in this chart is I've kept everything else equal. So the success rate of not running out of money is 80%, his fees, etc. But all I did is look at how much can he earn, how much income can he draw if he puts his living annuity in an income solution compared to putting his living annuity in a high equity solution. And it's literally double. So you can draw 20,000 rand a month salary investing in income, nice and steady, no major upsets month to month in terms of his statements, or he can double his salary if he stretches his focus to the long term and invest in a high equity type solution. So again, very powerful. So just to conclude, when saving for retirement, time is your best friend and growth from equity markets is your most powerful tool. And I really hope that the content we share today will help you get that message across to clients to help them make better decisions for their retirement planning. Thank you very much.